Welcome back to another episode of the Tip Share. This week, how to start a restaurant, the ultimate financial plan. So, you'd like to know how to start a restaurant business, but you're not exactly sure where to begin. You want to start a restaurant, and you create the ideal concept in your head. That concept begins with the idea at its inception. However, for your idea to survive, or even better, to thrive, it must operate on a consistently executed financial plan and a sound restaurant business proposal. 50% of restaurant concepts we see are largely inspired by existing operations. Beyond this, 85% of your food and supply purchases will be delivered from the same major distribution companies. So then, what is it that makes your new restaurant stand out? What makes this experience like nothing we've ever seen before? Unfortunately, the reality here is that without a sound and detailed financial plan and a commitment to following it, 75% of restaurant startups will be bankrupt within the first 24 months. So let's take a look at what makes up a great business plan for a restaurant. An executive summary, a market overview, capital expenses, forecasting sales, a restaurant labor matrix, a restaurant pro forma, and cash flow basics. Before we start talking about high-level concepts, let's begin with the broadest notion in how to start a restaurant business, the executive summary of your restaurant. In other words, you need to lay out a mission statement. Any well-designed mission statement answers the following key questions. We consider this your complete restaurant vision. So the questions are as follows. Why are you in business? What unique offerings will your restaurant provide that others can't or don't? Who are the key players that will create and foster your business culture? Where will your restaurant be in 6 months or even 6 years? Having both short and long-term goals is critical in devising a meaningful mission statement and the eventual business plan for your restaurant. Once you establish your mission statement, it's time to think about the concept and execution of your restaurant's business proposal, and important factors like capital expenses, sales, the restaurant labor matrix, and other significant considerations, which we'll cover in a minute. First, let's look at capital expenses and forecasting sales, imperative for writing a restaurant's business plan. With the executive summary buttoned up, it's time to roll up your sleeves and tackle the loaded question of how to start a restaurant business. The next step is to conduct some good old-fashioned market research. A thorough market overview assists in determining how your restaurant integrates and excels in the current business climate. In other words, the business plan for your restaurant should account for these things. For business trends, what are the key indicators of your restaurant's neighborhood and other regional eateries? Think growth trends, changing demographics, which relatively new restaurants have succeeded, and more importantly, why they have succeeded. Specific market goals. Will your menu fill the gap with the market, or compete directly with similar cuisine offerings already existing? Projected growth. Has your local market gained or lost population in recent years? Is the neighborhood on the upswing? These are important questions to ask when thinking about where your restaurant will be 5, 10, or even 20 years from now. Closely related to the trends and goals we just listed, your restaurant's business proposal should factor in things like menu pricing, competitor research, customer feedback, etc. Capital expenses is the category of purchases we use to describe startup costs. Within capital expenses, there are subgroups that assist in identifying your build-out needs. Some examples of these subgroups are as follows. Leasehold improvements, professional services, operating, computer, and restaurant equipment. These are just some subgroups, just to name a few. Each of these groups has a different amortization and depreciation schedule that is assigned to them. In most of the plans we see, Folks will use a poor estimate of what the aforementioned items will cost, with the thought that once they get the doors open, everything will just work its way out because they have perceived cash rolling in by the truckload. More often than not, this isn't the case. Therefore, carefully planning your build-out costs and capital expenses will save you in so many ways after you're open. Similar to budgeting for your expenses, you'll need a strategy for forecasting your restaurant sales. Most folks will estimate their sales based on several unscientific methods, let's be honest. First, they'll use the sales from the restaurant where they used to work, or they'll ask the manager at their favorite restaurant what their sales are. Another mistake we often see is they'll simply take the square footage and divide it by what they think they'll do in a week of sales. While these concepts have some elements for what is correct, it's not a complete picture. What you need to do instead is you must take the key indicators below into account to effectively forecast your restaurant sales. Day parts. Does your restaurant serve breakfast, lunch, and dinner? Or does it just serve brunch on the weekends? What are the day parts? Revenue centers. Do you have a bar, dining room, and patio? Do you have catering and private dining? What are the revenue centers for your business? Guest check average. What are your guests going to spend on average for each day part? Review our article on menu engineering to accurately determine contribution margin per item. Number of seats. This indicator is important because each seat is going to generate a certain amount of revenue. 2 tops, 4 tops, banquet seating, flip-up rounds, bar stools, and fixed seating will all differently determine the maximum amount of revenue that you can generate from your restaurant. And finally, table turns. It's important to know how many times you believe that you're going to turn over tables in the restaurant. For example, if you have 200 seats and you have 2 table turns, then you're saying that you'll seat 400 guests. Now, hang tight, because we're going into the matrix. The restaurant labor matrix, that is. First-time restaurant operators rarely forecast their opening labor needs accurately. Restaurant labor must be forecast using a detailed labor mix. Each day and day part, number of hourly and salary positions per job code, work center, and estimated wages must be calculated against your projected weekly sales. This enables you to accurately forecast how much cash you need to properly service your guests. More importantly, using a labor matrix allows you to react quickly during the erratic sales spikes that you're sure to experience during your opening months. Developing an accurate pro forma not only rounds out your financial plan and solidifies your restaurant business proposal, but it also provides you with the greatest chance of operating a successful restaurant. It is necessary that your pro forma is detailed and contains your revenue and expenses by period. Restaurants should operate on a 13-period or 445 financial statement cycle versus a monthly accounting cycle. Therefore, the year is divided into 13 periods containing 4 weeks or 28 days per period, or 12 periods containing 2 4-week periods followed by 1 5-week period. These cycles ensure that when you're reviewing historical and current data, you can look at trend comparisons and know you're comparing apples to apples. Further categorical breakdowns look like this. The prime cost breakdown. This includes food, beverage, and labor, including payroll taxes. Gross profit calculation, sales minus cost of goods. Direct operating costs. These are all self-inflicted costs, including items such as linens, restaurant, kitchen, and bar supplies, china, glassware, silverware, etc. Advertising and marketing plan, both in-house and external advertising and promotional activities. Repair and maintenance, all repair and maintenance activities. General and administrative, items such as legal and accounting, dues and subscriptions, credit card expenses, etc. Occupancy costs. This is going to include things like rent, utilities, trash, telephone, etc. EBITDA. EBITDA is earnings before income tax, depreciation, and amortization. Finally, your pro forma needs to be forecasted for 5 years, detailing sales growth, as well as expense changes such as rent or payroll tax increases and increases in cost of goods. Doing so will provide your investors with a reasonable expectation for payback on their loans or investment. Your restaurant's budget, perhaps more than anything else, will ultimately determine your restaurant's successful transition from a startup eatery to an established enterprise. Understanding your cash flow statement helps simplify, streamline, and track the cash coming into and going out of your restaurant. Let's look at the fundamentals of cash flow, which will help immensely when writing a restaurant business plan. The 3 main line items include the following. Cash beginning balance. This is available cash from your previous balance sheet. For the initial business plan of your restaurant, this is essentially your startup cash. Cash flow from operating activity. All the credits and debits associated with your restaurant business. Credits are revenue from food sales, merchandise sales, etc. Debits are inventory costs, rent, labor expenses, etc. Net profit or loss. In any given accounting period, 1 week, 2 weeks, 3 months, etc., your net profit or loss is basically the difference between your restaurant's gross profit or loss and the expenses associated with running the restaurant business. A positive value indicates a net profit. A negative amount reflects a net loss. Knowing how to utilize and track your restaurant's cash flow is essential to writing a restaurant's business plan. For more information on the function of your restaurant's cash flow statement and how it impacts your restaurant's business proposal, check out RASI's helpful article specifically on this subject. RASI's complete suite of restaurant business accounting services helps transform your concept into reality. From POS integration to financial reporting and much more, our agile, intelligent solutions empower and enable restaurant owners to have full confidence in their business finances, allowing you to focus on other business-critical tasks like menu engineering, promotional events, and more. You can always request a free demo at rasiusa.com, where we'd love to review your concept and offer practical, affordable restaurant accounting services to help your business grow. That's it. That's this week's episode of The Tip Share. We hope you enjoyed. And as always, we'll see you next week.